Okay, so in the interest of time, I suggest that we start. So good afternoon, everybody. I am Sara Baldi, Senior Policy Manager at the Federation of European Security Exchanges. We are very happy to welcome you today to this webinar on retail investing. This follows the equity and market data and the derivatives MCCP webinars that we organized last year, and is part of a series of educational seminars designed to give you an overview of the financial industry and its regulatory landscape. The recordings, but as well the presentation of the past events are available online. The seminar today is organized in cooperation with the Deutsche Akte Institute, the association representing German issuer and advocating for equity in Germany and in Europe. The seminar will be presented by our trainer, Dr. Gerrit Fey, Head of Capital Markets Department at the Deutsche Akte Institute, DAI, Dr. Norbert Kuhn, Deputy Head of Capital Markets Department at DAI, Donato Di Dio, Policy Advisor, Capital Markets Policy and Digitization at DAI, and Dr. Sandra Vincent, Head of Market Structure and Regulation at Deutsche Börse. Welcome. Before getting into the details of the session, I have a couple of housekeeping announcements to make. So I will ask all participants to unmute yourself and close the video. There will be a Q&A session at the end, but please feel free to interact with the presenter during the section. You can either write the questions via the chat or use the small icon on top of the screen to raise your hand so that the speaker can see you. Please also know that the video will be recorded. I know that most of you are very familiar with FESE, so I will just briefly present us by saying that we represent 36 exchanges in equity, bonds, and derivatives, as well as 13 MTFs. We have also here a couple of slides summarizing figures which show the size of European financial markets in terms of number of listed companies, market capitalization, money raised through IPOs, and equity, exchanges traded derivatives, and bonds turnover. And we have also summarized here the key facts about exchanges in terms of what they do and for what purposes. I'm just going very quickly through them because we will circulate this presentation afterwards. So today we will focus on retail investing, and the main topic addressed will tackle how is retail participation evolving and which impact does it have on the economy. How can we lower the barrier to entry to financial markets, and also why is payment for order flow contentious? How does it work? The webinar will be structured in 4 sections, which will cover basic concept, facts and figures. Why is retail participation important? How do we explain the limited participation puzzle and what policy option could be considered? And the issues of payment for order flow. As I said earlier, we will have a short Q&A session at the end, but in case of doubts or questions, please don't hesitate to raise them along the way. So without further ado now, let me leave the floor to Norbert. Thank you.
So thank you very much, Sarah, for the nice introduction, for the friendly introduction. I'm Norbert Kuhn from Deutsches Aktieninstitut. My colleagues Donato and Gerrit and me, we will give you a short introduction to retail participation, retail investments, where we have some figures for you, where do we stand and what shall be done or what shall we do. As Sarah just mentioned, Deutsches Aktieninstitut is an association of German stock-listed companies and other companies which are interested in capital market developments in Germany. Our focus is on equity culture in Germany and retail investment as well. We wrote a lot of studies, a lot of papers to this issue. We made a lot of recommendations. Some of them we will introduce today to you. And as you might experience from other countries as well, it's a very challenging issue we deal with. And of course, we very much welcome every political initiative regarding retail investments, regarding improving retail investments, and therefore we also welcomed the consultation of the EU Commission Retail Investment Strategy for Europe. Here you see some more general phrases about this consultation. We took also part in this consultation, and we think that one benefit is of retail investment. It's an economy that works for people. This is a very nice phrase which describes the issue we deal today very well. And the other issue, and that is something we will come to later on, is that the EU Commission wants to improve the legal framework for retail investment, and this is something where the EU Commission or the EU legislator is in charge with, and we will also see that many of our recommendations, which we discussed today, are more or less a national thing and not really in the competence of the EU legislator. As I said, this was the consultation. The consultation is closed last year, and this was the result, more or less, the hot topics of the consultation, as the participants of the consultation were asked to name what they think are really important issues which could be solved by the EU legislator. And some of them we will also discuss today. First of all, the rank 1 is financial literacy. 70% in this consultation on retail investment strategy said that financial literacy is very important to improve retail investments in Europe. That's an opinion we share, we agree totally, and we will return to this later on. Then the next one is digital innovation. There are more or less asked something like if information could be readable by machines, like some kind of influencers on some kind of online platforms and so on. We focus today on new broker platforms, the so-called neo-broker, like the US Robinhood, or in Germany we have Trade Republic or Scalable, and we focus on the business model and especially where the revenues come from. It's pay for order flow, but this is not our issue. This is one Sandra is dealing with later on. And then the last three things which are mentioned are really in the capacity of the EU legislator. Disclosure requirements like cost disclosure requirements in the banking advice or investment advice, the PRIPS regulation. I think you all know this, that issuers of complex investment products are required to provide a key information document, and suitability. This is also something you know from investment advice, where clients were assessed if or what product fits their needs, which is suitable for them, which is appropriate for them. And this is also an issue we will come to later. These 5 topics are more or less an issue which could be dealt on EU legislator level, but we think that we should expand this issues a little bit, and there are more important things we can do to promote retail investment in Europe or on national level, and we will return to this later. These are tax incentives, employee share ownership, these are pension systems, and of course financial literacy. Well, this is some kind of, or that's what to say as introduction, and now I hand over to my colleague Donato, which will give you a brief overview of retail investment in Europe and where do we stand.
Yeah, thanks, Norbert. My name is Donato, Policy Advisor at Deutsches Aktieninstitut. I think before we can tackle the issue how we can raise retail participation, we have to make clear what retail participation is in the first place. If you saw the quote from Norbert's slide, I think it was quite vague in the EU Commission's report. But from our point of view, from the Bureau of Dutch Act Institute, you can differentiate two forms of retail participation with different needs, different policy fields, and different initiatives from the EU and member state side. Yeah, let's focus on the retail participation in a narrow sense. We think that here people invest their money in the stock market rather directly and try to lay the foundation for a comfortable life in the future, maybe buy a house or buy a nice car. But you know, where people invest money to help make it grow with a not so clear goal in mind. The second form is rather broad. We called it broad in the broad sense retail participation. And here people come in contact with the stock market or capital markets rather indirectly through first the employer, through, as Norbert said, employee ownership programs, or through the pension system. And here the motivation is slightly different, and that's important. Yeah, let's focus on the middle of the figure there. When people take part in the employee stock ownership programs, employers can raise the engagement and motivation of their employees, and at the same time, employees or European people can gain a meaningful voice in the company's affairs and play an active role in the transformation process. So you can see on the last block, motivation, as you see ownership, like transform the company, have a voice in the company's affairs, and at the same time, like in a narrow sense, building wealth through their stock options or the stocks of their company. And last but not least, people can take part at the stock market through their pension system. When the pension scheme is linked to the stock market, if you think like the Swedish AP7 fund or the of the Dutch pension system, these systems tend to link their pension saving to the stock market, and this again is a rather indirect form from retail participation, but for people, but with a clear goal in mind: saving for retirement and closing the pension gap. So we learned there's a narrow sense, people try to invest directly, and there's a broad sense where people come in contact rather indirectly. So what are the instruments that European people can invest in rather broadly? I know it's narrowed down here because we don't have enough time, but let's go through it. Okay, what can the European retail investor in general invest in? On the left side, he or she can invest in stocks. Maybe a little explainer: stock is a unit of ownership in a company that more or less represents a piece of a company's asset and revenue. You can also invest in debt instruments called bonds. Bonds are, a little explainer here, something like a document that acknowledges the existence of a debt of a company or a state, and the owner of the bond is entitled to receive a payment from that issuer. And a bond can be issued, as listed here, from a corporate, like, I don't know, Siemens, and from a state, from a government like the Netherlands or Italy or Germany. Then there are mutual funds. Mutual funds are for people that want to invest in multiple companies or other instruments at once. Mutual funds give people a way to invest in a mix of stocks, bonds, maybe derivatives, maybe other securities, by buying shares of a financial vehicle that is managed by a professional. By buying stocks, it's like if you buy, let's say, a pre-packed salad at the store. You can go into the store, buy a salad, And in that salad, there's tomato, there's Caesar salad, there are onions, and there are other vegetables, hopefully, in your salad. But you buy it pre-packaged. That's the thing. And there are two forms of these salads, two forms of these funds. There are active funds where a fund manager is picking stocks and other securities for the stock market for you. It's like when, I don't know, when a chef is making you the salad to order. And there are passive forms of mutual funds, like, I don't know if you heard the ETFs. And ETFs, let's make it short, are slightly different. You buy a big basket of stocks or a big basket of pre-packaged salads. And these ETFs are often designed to passively track a particular industry or index. Indexes like the S&P 500, the DAX 40, or the Dow Jones. And in this way, you need little human interaction from fund managers, and so the fees can be lowered. Let's go to the last security retail people can buy. And let's keep it short here, because derivatives is a rather complicated issue. But in short, a derivative is a contract that is based on the value of something else, such as gold or something. But to be honest, I think derivatives play a minor role for retail investors. So in general, we should just keep in mind, retail investors can buy derivatives, but they are not so important in the broad scheme of things. Before we answer the questions why retail investment isn't bigger in Europe, let's lay our eyes on some key facts here. When you look at the American households, $38 trillion worth of equities, or 55% of financial assets of US households, are held in securities and other assets. When you compare to the European saver, they have, let's say, less contact with the stock market. Only in Western Europe, this proportion is just under 82%. So I brought you a slide here. On that slide, you can see the household financial assets of different regions in the world. And as you can clearly see, the US is leading the pack here. 53% of household assets are held in securities. And if you see in Europe, you can see very big regional differences. Like in Eastern Europe, 33% of household financial assets are held in securities, and in Western Europe, that proportion is slightly lower. Only 28% is held in assets. I see a hand risen. I got Rodriguez. Maybe, let's say, just ask right in.
Okay. No, it's just it's quite interesting. And you mentioned some differences, but would you perhaps know why there's these differences? Is it more historical, cultural, or yeah?
The presentation is going to tackle some of these differences and the stock root of these differences, but a glimpse into the future, we think the American let's say US system is slightly different. In the capital has a different capital market culture, we call it here in Germany. They're used to buy stocks through the pension system. They're used to buy stocks to build wealth. And in the next slide, maybe we can differentiate the US system from the European, or let's say broad European system later on, if it's okay for you. I think.
Sure.
So we are here with the household interest, and we don't have the numbers here, but Americans in the last 5 years got considerably richer than Europeans per capita, and that's in large part to a nice proof from their stock market holdings in the last 5 years. So I think I have to give it now to Gerrit. Head over to Gerrit. Yes.
I have to unmute myself. Hello from my side. So I've just very briefly touching on the issue why retail participation is important at the end. So we have talked a lot about the figures and the outline of our presentation. And just to make a long story short, we think there are at least three main things, main effects that we should have in mind when we talk about retail participation. The one is just, as it is put here, in the long-term perspective, the yields from savings in equity in particular are simply higher than from other savings, particularly bank deposits. So what Donato explained at the very beginning, it's quite easier to build up wealth with capital market instruments, particularly in the long term. And that also holds true indirectly for the question of retirement provisions. And just also here, it makes a difference whether your pension system is designed in a way as a pay-as-you-go system, where just where people that are paying for that system, these fees, these endowments are directly channeled into the retirees, those who receive pensions at the end of the day, or if there's a capital stock in the system, in particular capital stock in stocks and equity. So that helps definitely, as the experience show, to close the pension gap which we have all over Europe and all over the world due to demographic factors. And last but not least, and that is the third issue that should we have in mind when we talk about retail participation. Retail participation is, at the end of the day, the ultimate source of the capital pool which can be invested in companies, in particular in corporate ventures. And so retail participation is also about financing the economy, in particular through long-term investments. So that is basically the outline, which will be now a little bit more detail on these slides. Here you see the first point, so some facts on long-term yields. On the left-hand side, you see a visualization of the stock market performance in Germany on the DAX 40 in the last 50 years, which we use in Germany to promote share investments in Germany. And for you see in the long term, everything is green. So the long term is the key message is, maybe I can try to make just a ring here. Nice tool. So what you see here is simply that is a short term. And what you see, short-term stock market, there are ups and downs. There might be crises. But there might be also just very significant stock market rises in the short term. So in other words, there's volatility. But in the long term, which is how that visualization works, the more you go to the right-hand button here, the longer is your investment period, everything is shaded green. And experience shows for the German market that on average, if you have an investment period of 20 years in mind, the average return has been roughly 9% for a broadly diversified equity portfolio, and with some deviations and some variance, but that is what could be expected from the German market at least. And when you have a look on the right-hand side of that slide, you see a very long-term perspective now, not in nominal returns, but in real returns. So in just also recognizing inflation, you see a big gap between equity investments here and that is government bonds. So in other words, overall equity investments does two things, and it is it's very suitable for wealth building, and that's on the next slide, old age provision, because old age provision is also on the long term. And you have two effects: either a saver gets more money back from its initial investment, at the same in the same period of time, or if he has a certain investment target, he needs to invest less to get to that target, so we can consume more. That is basically the story why long-term benefits and long-term yields are so important for wealth building, and that is visualized in that slide. But having in mind the audience that is well known to all of you, I think, or most of you. The story on old age provision and systems of old age provisions, pension system can even made shorter. Here we have just a figure taken from a Mercer report, which just tries to summarize the quality of pension systems. And we have marked in red here systems that have a big part and that rely relatively much on equity investments. And for us, it's no just surprise that, as it put in the last bullet here, that pension system that emphasize more on stock savings generally tend to be more sustainable, cheaper, and rank higher in such international studies. We would not say everything must be put in a stock market or so, but we are just basically say if we can just implement pension systems that put at least some money in the stock market, the pensioners will benefit, but also, and that is on the next slide, that just significantly contributes to the capital pool of which is available for companies that need finance for economy. So if we talk about retail investments, I already mentioned that at the beginning. We also talk about what is done with the money the savers put in the capital market. And the experience is relatively clear here. The more money is available in the capital markets, the more money can be invested in corporate ventures. So generally, we have no slide on that. You can just can see that the ecosystem, as we could put that for growth and capital markets development, just is better in systems where much money is channeled to capital markets, either by savings of the investors or by pension systems. And you can, for example, see that then you have more IPOs, you have more venture capital, you have more just more companies engaging in the capital market, and so we have more life in the capital markets, which is very important to discover new opportunities and create innovation. Maybe one just snapshot, if you like to put it that way, is illustrated with that figure here. That is just saying the left-hand bar says that roughly 70% of the big tech companies, the market capitalizations, or the market capitalization of the big tech companies, 70% of that is in the US. In Europe, that is the third bar here, it is simply roughly 7%. So what does that tell us? Tell us that just Europe is simply lacking the Amazons, Googles, Microsofts, and Apples of the world. And we, as Deutsches Aktieninstitut, are also concerned that holds not only true for the big, well-known big tech companies that we already know and which have shown a big performance in the last 20 years, but it might also hold true for new ventures and new companies coming up, for example, in the biotech sector. So just to make that story here short, when we talk about retail participation, it's important that we do not only talk about the individual perspective of an individual private investor, but we also talk about macroeconomic effects. One on the reliability and sustainability of the pension system, and a second on corporate finance. So that's about why it's interesting and why we should be interested in retail participation. So now I hand over the floor again to you, Domato, just to run through the slides, which just try to characterize and classify what can be done.
Yeah. Thanks, Gerrit. Let's try to explain, or let's say solve the puzzle, or at least give you some food for thought. We at Deutsches Aktieninstitut identified 4 main stakeholders, which are in the big system of retail participations, all with different needs, all with different regulatory backgrounds. But we think if the right environment at the EU and member state level are in place, we think we can raise this retail investor participation with all the benefits Gerrit and Norbert told you about. Of course, we think you have to make the European people or the retail investors, as the slide says here, center stage of your policy options. You have to ask, what are the needs? How can we help them to access the stock market more easily, to make it easier for them, maybe through tax incentives, to buy stocks? But you also have to take the banks into focus and other advisors, because they play a major role. They are maybe the most important financial intermediary, because they stand between the savers and the capital markets, and a lot of people, and I know it's hard to imagine in my age group, but a lot of people are still buying and selling stocks through their banks or financial advisors, and these banks and financial advisors offer important advice for their customers. So we have to make it, on the one hand, easy for the banks to advise their clients, but on the other side, have good investor protection law in place. Let's say it's a balance we have to strike, and we need. I think Norbert, it's in the next slides, is going to tell you a little bit about this. The third major role plays securities markets. They're matching buyers and sellers. But Norbert and Gerrit are talking about the other 3 issues later, the securities markets. I think we have the expert here. Maybe she can shed some light later on that topic. And last but not least, there are companies that are raising money by offering stocks through their IPOs and or emitting corporate bonds to raise money for their business and develop it, and maybe or hopefully provide jobs and help the economy grow in the future. So let's dive right in. Let's click it through here, it's better. So we think that the investor is one of the most important, not policy option, but one of the most important topics you can tackle here. We see 4 policy fields, or we call it fields of action, that EU institutions and member states can move, so we can raise the retail participation. The first is financial literacy. I'm going to talk a little bit more about that in the next slide. The tax environment, employee participation schemes, and last but not least, and maybe one of the most important things, the pension system. So we think, or at least I think, in Europe there's let's say a perception from retail investors that capital markets are difficult to access, are reserved only for the rich and wealthy, and if you read tabloids all the time, maybe that the stock market is crashing like every 2 years. So all 3 points, of course, are false. But if you only read tabloid headlines, or when the subject of finance is not taught in school, maybe you can understand there's a lack of trust from the European people into the financial system. And one way to tackle that lack of trust is through financial literacy. When you, and I looked these stats up like yesterday, but when you look into the statistics regarding that topic, I think the view into the future is, let's say, not that optimistic. Only 50% of adults in the European Union are financial literate. And this figure varies widely across the European Union. If you look in the North member states, these figures are like 80 to 70% of people are financial literate. And if you look more into the East or the South of the European Union, this figure is decreasing rapidly. So let's be clear here. in the education policy field, member states are in the driver's seat, and the EU can only use the so-called method of open coordination, and this method relies heavily on soft law mechanisms such as guidelines, benchmarking, or sharing best practices. And in short, it's like if the European Union is putting peer pressure on the member states, because I think no member states wants to be seen last in any given policy field if you rank them. So I think it's the soft law mechanism. It's not a EU directive or something. But if EU is publishing studies, we think at least the EU can move something in that field. And the EU is trying. It's trying here. It's financial literacy is part of the Capital Markets Union Action Plan to empower European citizens. The European Commission has published a joint with the EU OECD a financial competence framework for adults, and the EU is trying to support the development of public policies and financial literacy programs and educational materials that will support the exchange of good practices by policymakers and stakeholders in the EU. You can see it's not a directive or other hard law, but if you publish such benchmarking, I think like the PISA study, you can move something. The next key element we think is the pension system. And I know every member state has a different pension system with different tax incentives and different cultural background. But like Gary said, on the macro level, we think that pension systems that use the stock market have advantages regarding the pension saver and the macroeconomic activities. We think if the pension system relies more heavily on stocks, you have a direct effect. So people are participating rather through your employee pension system or other pension systems directly through the capital markets, and indirectly is the second bullet there. They get used to it. They get used to the capital markets. They get used to see volatility. They get used to see how their money grows over a long period of time if they are saving through their pension system and with stocks. So again, let's be clear. In the pensions policy field, member states are in the driver's seat. But as I said, the EU can write studies, can show EU-wide best practices, can analyze strengths and weaknesses of every system, and maybe it's a story for another time. But the EU can also introduce special pension products, or did introduce a special pension product named PEP, which give people more choice. But in the interest of time, I think regarding PEP, let's say it's a story for another time. But we liked PEP at Deutsches Aktieninstitut, but we see some design flaws because it's rather an insurance than a savings product in the basic PEP. So yeah, we think the pension system is a key element, and with this, I give to Norbert, I think.
Maybe, Donato, if you don't
Yes.
mind, just in a couple of words, because indeed for the interest of time, but if you could elaborate a bit further on the PEP, just to say, in your opinion, what are the major flaws of these products, which there was quite a big hype when it was first launched, and then it did not prove the success that probably was intended. So in your opinion, what are the main reasons behind this? Thank you.
I can only talk for Deutsches Aktieninstitut, not but yeah, you're right. There was a lot of hype. Norbert and I were quite happy to see the PEP proposal at first, but PEP, or the Pan-European Pension product, has, we think, two main flaws. First, it's rather dependent on the member states to implement such a product. And second, a lot of pension products rely heavily on tax incentives. So if you save in that pension product, you are not entitled, but you're hoping to get some tax advantages, like you don't have to pay that's, I don't know, but the tax, like your loan tax or other taxes, and that is heavily dependent on the member states legislator to give the same tax incentives to the European pension product. And the second flaw is that at least in the basic PEP, the default PEP, there is some guarantee element involved, so that the provider or mutual fund or something can't invest all your savings into the stock market over the long run, because they have to guarantee that in the end you have some kind of output that is guaranteed. So Norbert, maybe you have something to add to this?
Yes, I can jump in, but it was I think it was very comprehensive. But regarding the guarantees, we think, as Donato said, we shouldn't, or we wouldn't say that you should put your whole money in the equity market. But in the low interest environment, it's more or less impossible to invest more in shares when you save in a product with guarantees. You must be very young, and yes, you must be very young, and you must have a very long time investment horizon. Otherwise, we see it in Germany with the so-called Riester pension. Most asset manager which provide funds under the Riester, and Riester has also a guarantee. They have only a minimum rate of shares as part of the asset allocation. And well, the problem is you don't get really returns from your pension product, because the cost of safeguarding the guarantees are so high due to your large investments in fixed income products, which return nearly to nothing. And then it's not really a good business to invest in interest times, which are in low interest times, to invest in such guarantee products. And I think this is our most important thing we criticize on PEP. And of course, pensions are a national issue. There are many tax incentives involved, and this is very difficult to agree on the European level. Well, as we have talked about tax incentives, we can come to the next issue we want to discuss with tax. And we think that tax incentives are very important to encourage retail investors to invest in shares, or maybe they can also disincentivize retail participation. First of all, of course, it is very important the tax rate on capital gains, on interest, on dividends. It's very important if you pay the whole tax, if you pay only the half of the tax, or you have other tax reliefs that you pay no tax. And of course, this influences your post-tax return on investment. And if you have really targeted tax incentives, you can also incentivize retail investors to take part in the stock market. And furthermore, I don't know if it is really a special or a specific German phenomenon. It has also psychological effects. In Germany, we had a lot of so-called tax-saving models where government provided tax relief, where you invested in real estate or whatever, and people invested in these tax-saving models because there were tax releases, and they don't look really on the returns, but they only look on the tax regime and the tax releases, and this seems to be a psychological effect that many people are driven by tax incentives in some investment classes. Well, taxes are not really on the agenda of the European Union. They are on the agenda of member states, but there are existing initiatives on the EU levels which strike also taxes. First of all, if we talk about incentives or disincentives for retail participation, we come along to the financial transaction tax. I think you are all familiar with that. This was a project launched in 2011 as reaction to the financial crisis 2008, and it was made under the motivation to let banks take part on the large amount of money which was spent after the financial crisis to rebuild the financial system. But then it is called the fate of the financial transaction tax. The scope of the tax was really narrowed. First, in the first ideas, they talked about taxation of derivatives, of bonds, of shares, and so on. And this scope was narrowed later on shares. As a role model, this was the French taxation system, the French financial tax. And what was also narrowed, or which was also decreased, was the participating member states. There were only 10 left, which took this project as part of the enhanced cooperation. And we know that especially the German government was the driver of this project under the finance minister Scholz, which is now a chancellor. But we also know that under the recent government, the so-called traffic light coalition, which reflects the colors of the parties involved in this coalition, they are not really driving this project anymore. And we hope, because we think that it's really a disincentive for retail participation, that this project will be buried in a cemetery where it belongs to. Then, of course, there's another initiative of the EU Commission on debt equity bias reduction allowances. This addresses the problem which we have in many member states, that equity is taxed twice. First, with corporate income tax on the company level, and then another one twice on investor level, while debt is only taxed on investor level. In Germany, we have this problem when you take €1 of company return or of company profit, it is taxed on company level with 30%. Then only 70 cents will be distributed to the investors, and this will furthermore taxed with 25%. Then from profits, share profits, they will only remain nearly 50% on investor level. And this is a problem which should be solved, as debt will be only taxed on investor level with 75%. And The Commission's proposal, which is more or less well some kind of technical help for the member states, proposes to make tax relief on the company level, but we would better, or we think it's better to make tax reliefs on investor level, because this signals the investors that shares and other capital market products, especially in equity, is a good investment. Then the last thing are individual saving accounts, which are discussed under the Capital Market Union project. These individual saving accounts are already implemented in 12 member states. This is some kind of account where you can save money, and this is invested on the capital market, especially in shares, and you have also tax relief. This is meant, for example, in the UK. This is they are no longer in the European Union, but this is a role model, the so-called individual investment accounts, and there you can put in this account £20,000 per year, and you can invest it, for example, in shares, and the returns of these amount of money regarding capital gains, regarding dividends, they are tax-free. And this is, of course, a very good incentive for retail investment. But of course, these are this is part of tax incentives, and it's difficult to implement on European level. So the next thing I want to turn to is employee share ownership. We think also this is a very good instrument to make shares more attractive, to improve investor participation in capital markets. What do we mean when we talk about employee share ownership? I think regarding the models, there are two models which could be differentiated. One, a discount share, where the employer provides the employees shares with a discount on the market price. Well, in practice, these are 30 or 40%, meaning that if the share costs 100%, which you buy on the exchange, you will get as employee for 60 euro or 70. Another model is so-called matching shares, where you buy now maybe 3 shares, and then the employer gives you one further share after a holding period of 2 or 3 years. These are the models we see on the market. What do you think is the contribution to retail investor participation? We think, of course, the discount which is provided by the employer helps to overcome the skepticism, which is already mentioned by my colleagues, on shares, because you have a loss buffer. When the share price decreases and you from 100 and you bought it for 60 euro, then you have 40 euro until you might have losses on your books. And we see that many investors panic when stock prices decrease, and they sell their shares, and there you have a loss buffer, and there's no reason to sell the shares. Then, of course, the company provides very important information on shares. They have to provide some kind of information document in these programs where they have to enlist the risk of the shares, the benefits of the shares, and this has some kind of educational effect. And third, we think that, of course, well, what was third? The it is a low hurdle for employees to invest in those shares because they know the business model of the company and they know, well, it's a good investment or not. So this, I think, is where we call it some kind of exit track in the share market. But nevertheless, employees should also learn to diversify their portfolio and not only to focus on shares in the company where they work, because this is addressed as, or this is named as a double risk. Maybe if the firm they work with and they held shares of, then it get insolvent. They not only lose their money, but also they lose their job. And there you see other benefits. Well, where can we see what the EU legislator should do? It's difficult because, as seen on the slide before, it depends on tax incentives, how these share programs are tax incentivized, and this is unfortunately not part of the EU legislator. But of course, this is some kind of, he could provide best practices and so on. Well, then we can leave the investor level, then we can turn to banks, financial service providers, and so on. What are the key objectives? Adequate advice. Donato mentioned it. Banks have some kind of messenger function. They can provide information about investment opportunities, about shares. They can provide about information about the risks and the benefits of those instruments. And this is, of course, a field of European legislation, regulation of investment advice. Well, Donato mentioned it is difficult to seek the right balance between investor protection and over-regulation. And we saw a bulk of regulation after the financial crisis in 2008. There are some key words on the slide like MiFID, like BRIEFs, and so on, and they are all targeted into the direction of investor protection. Banks have to fulfill a lot of obligation regarding documentation, for example, suitability reports. They have to assess whether the product is appropriate for the investor, whether it suits his needs, and so on. They have provide a lot of information, for example, key information documents, and the list is much longer. But these are two examples for the obligations they have to comply with now. We think that this has led to negative side effects. First of all, information overload. We heard, or it was conducted in many studies, that investors are a little bit bored when they go into the investment advice or in banks and get investment advice, because it's very long. It takes a long time to document the whole information they have to deliver, and so on. And it's very difficult, as it takes so long, to benefit from investment opportunity. Maybe when a share price has dropped, and then to buy this share very fast and immediately. Then, of course, what is also a problem, banks refrain more and more from advice due to regulatory costs and liability risks, and therefore their role as multipliers are limited more and more, and advice becomes scarce good. I think, or we think, that a legislator take this into consideration. They acknowledge that maybe regulation is too tight regarding investment advice, and there are some initiatives for relief. For example, in the MiFID review, where investor protection rules are evaluated, and where some some proposals or some improvements are proposed. For example, what we think is a very good thing which should be elaborated further is the so-called semi-professional investor. This is some kind of experienced investor who is allowed to waive some of the documentation or information obligation or all of them. Well, but new investor protection rules are arising regarding sustainable investments, where banks, when they have to check sustainability preferences of clients, they have to build up very bureaucratic processes to evaluate this. Well, this is the part of banks, and now I hand over to Gerrit, and you will continue with the other issues.
And coming to an end soon. so just the third factor, I think I
get it. You're on mute. We only hear a few
Norbert's mic. So no, we just changed the microphones. So again, myself. So I'm just referring to the third factor, which can be influenced. The third stakeholder would be security markets. So what is here the key objective? It is having a fair and transparent, cost-effective trading opportunities for investors, so that buyers and sellers can be matched effectively, and at least, last but not least, a certain level of competition among trading venues. That is basically what is here about. And but however, I can skip that, I think, because that will be presented from perspective of Deutsche Börse by Sandra in a few minutes. So I will concentrate on the last player, the last stakeholder, where Deutsches Aktieninstitut is particularly involved, because the core membership of our organization are listed companies. And also listed companies has something to do with retail participation, because as Donato said at the very beginning, they offer the securities where investors can invest in. So what is here the issue? The issue is here, on the one hand, enough supply. So you need a high number of listed companies so that investors have choices. On the other hand, investors need sufficient information from that companies in order to have low hurdles and just low information hurdles to invest in that companies. Although that is a issue of regulation, the regulation of listed company in that case, and I can make that story also very short. Here it is about also of getting the right balance, as it is with investment advice, as it is with the regulation of markets, as it is with all the other fields. We are coming from an era of steadily increasing requirements for listed companies, because that has been a key area of action for the European Union over the past 20 years. Some examples are just here on the slide: the EU Transparency Directive 1 and 2, the Market Abuse Directive, which is about, for example, insider dealings and publication of inside information, or the IRS regulation, which just defines how accounts have to be just produced and what information has to be just announced from a material perspective. The Prospectus Directive and Regulation 1 and 2, which just defines when just an issue is going to the market at the first time to issue a new instrument, which information has to be provided to the investor in that case. Though just slightly shortly, that you can see we have a high level of investor protection here created, so mainly prohibitions, but also information demand obligations of issuers and listed companies. However, that comes at a cost. So in particular, smaller issuers, but also large ones, just really struggle with the immense bulk of regulation they have to comply with. And what you can see as a side effect is that the number of listed companies is steadily decreasing in the last years. And fortunately, that is already on the agenda of the European Union. We have the feeling that the minds are changing in a way that, yeah, that message is understood now, and that just the legislator is trying to get the balance improved. So you may know the consultation on the EU Listing Act, which is out since I think November last year, and this consultation picks up a number of issues that are highly relevant for listed companies in terms of compliance costs and risks. And so we have the impression that that is a very important initiative which needs to be supported in order to make it easier for companies to enter into the capital markets and provide investment targets. However, on the other hand, it's quite similar to that what Norbert said on banks giving advice. We have that Green Deal discussion and Green Deal targets of the EU Commission, which is fully supported in essence by us. However, we have increasingly the feeling that the growing regulation in that field might overburden companies if it's not properly designed, and if companies have not enough time to adjust to that new rules. Though also here we have it's about keeping the right balance. If you overburden those who just are the investment targets for retail investors, you might not wonder if they don't enter the market. And in the essence, you have less investment targets at the end of the day where investors can invest in. And that does something with retail participation. So to sum up, we have talked a lot about the key factors to influence, or if you like to put it another way, the stakeholders in the process. You've seen that on the side of the investors, it's most about empowering people and setting right incentives so that they are willing to invest in the market. When Norbert and Donato have just elaborated much on the fields that are relevant here. And I think if you sum up, you might have recognized that the role of the EU is somewhat different than in the other fields. Though it's rather limited in a certain sense, because most of these fields are basically in the national competence and will rest in the national competence, because taxes is a very sensitive issue. Financial literacy has something to do with the system of education. Employee participation has to do with the tax structure, but also with the company structure. Pension systems have long traditions and just need to be adjusted to other institutions in respective member states. So the role of the EU is rather the role of a moderator, a role of setting impulses, and in the one or certain cases, some cross-border issues might be touched, but it's rather limited in a material sense. When we just come to the other things, we have seen that we basically are talking about regulation. We are talking regulation of banks and investment advice. We're talking about regulation of trading venues, of different stock exchanges, multiple trading facilities, what you name it. And you're talking about listing companies. And here it's quite clear that is a key competence of the European Union. And it's also, as you have seen on our slides, we have a long tradition in do that, because it's about creating internal markets. And by and large, I would say, and that's our impression, the European Union has done much in the past 20 years to improve investor protection, and it has been successful with that objective. So European investors are protected. They are informed. There are a lot of compliance duties for all of the stakeholders involved. And so our feeling is we have not a lack of investor protection. There might be some areas where some minor adjustment can be done, but overall we have a high level of investor protection. However, we feel that the legislator tended to just not to recognize potential negative side effects resulting from that ever increasing regulation. And I talked about listed companies which are more or less reluctant to join the market. Norbert has talked about banks which just reduce yeah, the level of advice they are willing to give to investors. And maybe Sandra will talk about something else. So what is our key messages here? If you're gonna just go into the regulation again, if you just do something, have in mind that investors are already heavily protected. They just maybe are already overloaded with some information, and have in mind that there's always a supply side in the market that is also necessary in order to have retail participation. That is a very important message. And I think we have just mentioned some initiative where we have the feeling that, yeah, the pendulum is just swinging a little bit back. So just, yeah, the legislator is thinking over and analyzing what the regulatory initiative of the past have done to the market. And I think it's always good to do that, you know, and just to just do some minor adjustment there. Yeah, that is from our view. Thank you very much. I think I speak in the name of all three of us, and I'm happy to receive questions, as are my colleagues. But maybe now it's your turn, Sandra, to just elaborate on security markets from the perspective of Deutsche Börse.
Yes, good afternoon. I think we might have also some more time afterwards in case you have more questions to my colleagues from the DAI. I will try and keep it also brief. And yeah, I'd like to discuss with you this afternoon the topic of payment for order flow. I think it's a very important topic that we are currently dealing with. And that has been raised a lot of interest as well over the last, I'd say, 2-3 years. Payment for order flow is basically nothing new. It has always existed, especially in the OTC markets, but it has increasing attention. We have seen a surge in retail flow over the last few years, in particular through the pandemic, and also the rise of sort of next to traditional brokers, more kind of neo brokers or zero commission brokers. But maybe before I start, let's all get us on the same page and briefly define and see that we have the same understanding what actually payment for order flow is. Quick question, can everyone see the slides? I think for me they look a bit in the small slide. Everyone can see the slides, is that fine? Okay, good. So
yeah, that's fine.
Okay, thank you, Sarah. So payment for order flow is basically when a broker systematically routes its retail flow to either like a systematic internalizer or to a certain execution venue or to a market maker, and in return he gets some payment for it. So according to MiFID, MiFID is a Markets and Financial Directive that came out, well, the first time in 2006, and then later on, obviously, there was a review. MiFID 2, it's some kind of an inducement, and there are certain rules and disclosure requirements for inducements, and inducements in particular, they are only allowed basically when this payment or the benefit is basically designed to enhance the quality of the service. And there are also more details on exactly what that means in MiFID itself, and also one very important point that's coming more from an investor protection point of view. If there's no basically conflict of interest, or if actually really the broker acts in a fair and honest way in the interest of a client. So what you can see here on this chart, I try to put this a little bit together. You have a retail investor, and basically you see it once with the flow of payment for order flow, how it works, and also how it would work without payment for order flow. So a standard flow, if a retail investor basically wants to buy a share, let's say Adidas, he sends this order, he tells his broker, his retail broker, I want to buy Adidas. The retail broker then, obviously according to the MiFID rules as well, he will then send it to an execution venue, most of the times a trading venue or a stock exchange. And then there, according to the rules and regs, which are all disclosed publicly in the central limit order book, the order will get executed against matching order. And then obviously the retail investor, as you can see, will then receive the stock. Now with payment for order flow, and this is basically the blue dark line, things look a bit different. So you also have the retail investor again, and he sends the order to his retail broker, who we have got here. And this retail broker, basically, he is basically connected also to different venues, and in his basically he allows for different venues basically where he could potentially send the order to. And there are also some, and I've made an example down here, where you have market makers, for example, Lion Schwarz or Getex or Quotrix, and they all have one market maker. These are called so-called one market maker models. And this market maker, he basically sees the order, and he also makes a payment towards the retail broker to receive that order flow. So in that sense, he's the only one that actually executes against that incoming retail order. So that's a difference also with regards here to an execution venue or a trading venue where it can be executed against any kind of order. And here it will always be the single market maker. You can also replace a single market maker here with a systematic internalizer. It just gives an example of it. And then basically the retail investor gets his stock booked in. Now, to give you some kind of dimension or feeling about how much we're actually talking about, it's difficult to get some numbers, to be honest, but we have done some estimates, and in Germany alone, like roughly in 2020, we estimate that the number of payment for order flows that have been sent is about over 100 million euros just for equities and ETFs, which is quite a lot, and compared to 2019, basically tripled. So you can really see an increase in payment for order flow over time. Don't have any numbers for 2021. Per average execution order, that's roughly for equities and ETFs, €1.50. When you look in some of the terms and conditions of some brokers, you can even see might even be higher, up to €3. When you also look for different types of products, such as structured products, for example, it could be even much higher. The terms and conditions reveal something between really €7.50 and €15 per execution. That's, if you think about it, it's quite a lot. So what we also have discovered, also to give you dimension, I think the amount of the share, the market share that some of these market maker or dealer-driven venues basically have, has also massively increased from 2019 to 2020, from like 6% to 20%. So there is quite, payment for order flow seems like really something that has emerged tremendously. However, I'd say, have to emphasize as well, it's been used not only because the zero commission brokers and the neo brokers have been quite in the focus, but it can also be, and it's also been used by traditional brokers. Okay, if there are any questions, please interrupt me. Otherwise, I'd like to move forward and basically show you also what actually then the retail broker, because he obviously receives the money, what does he actually offer in return for this? So I think the first thing is they basically steer the order flow by basically saying that, okay, they change their best execution policies. So some of the trading venues, for example, disappear, or also from the order entry masks for the retail broker. Some of the trading venues do not appear anymore because they're not making any payments. Which effectively means if you're not making any payment, you're not part of the pay-to-play model. Hence, you disappear. You have no chance of being part to receive that flow, basically. And those ones that obviously want to receive the flow, they make these kind of payments. And what we can see here, they really there's a competition happening around payments. It's not actually about prices anymore. It's really about payments, who pays the highest fee to get that order flow. Then I mentioned already zero commission brokers. Yeah, they also select a lot the zero commission brokers. They also, what you can find, they have quite aggressive marketing strategies. So if, for example, also for self-directed flow, so if a retailer can always say, oh, I want to make the choice myself, or I follow the advice from the retail broker. if he wants to obviously direct the flow himself, maybe in the order entry mask, even where he wants to send it to a trading venue or to a stock exchange, the classic stock exchange, to central limit order book. Then some of the brokers have even then put a surcharge on top of the of sending it there. So basically like a penalty fee. That's also what we can observe or have observed in the past. And the final point is what they also basically offer in return is basically in terms of disclosing information about how much is being paid and not for such an order. It's sometimes not very accurate or difficult to understand, or for retailer also hard to find. And sometimes it's only if you request it yourself, if you say, you know, how much can you please show me the details of the execution, then you only get this ex post, and it can also take some time. And for someone that's not so familiar with trading, it might be even very difficult to understand. So that's sort of I think to summarize from a retail broker what he actually in return for payment actually gets. And I come now to a point where I like to sort of have a short discussion or sort of short kind of viewpoint in terms of what is there actually then a problem with payment for order flow. As you may have heard already from what I've been saying, yes, we believe there is some kind of there are some issues with payment for order flow, and this is also currently being discussed on the European level. So I think one fundamental thing is the question that you have asked, or that we ask ourselves. So if, according to MiFID rules as well, the retail broker is obviously supposed to act in the best interest of the client, and how is that possible if then also he's supposed to then obviously direct the flow to those venues that pay to get the order flow? That seems a bit fundamentally difficult to say. Is there not an sort of a per se basically conflict for interest? And that has, from our perspective, also detrimental effects on price efficiency. I come to that in a moment as well. I think to give you also an example is ETF saving plans. They're very popular in Germany, and obviously, as we heard earlier on before and as well, the importance of retail investing and participation. ETFs are sort of, you know, we have quite diversified investment, and they're very popular in Germany. And there are, for example, on the reference market on Xetra, they are for free, no transaction tax, no transaction costs. And the majority of the saving plans are still gets executed on venues with offer payment for order flow. It's if you pay 4 basis points for an ETF saving plan, then you know, the market maker, well, he has got sort of knowledge of everything, like the eyes in the day, the time, the volume. It's quite questionable actually if the investor really receives best execution. And you could also ask the question, how can a market maker afford to pay 4 basis points and then also provide the best price for it for the client? And I think I don't have to answer that question, but I think it gives you some thoughts about what's actually happening there. I mentioned as well that there might be some effects or detrimental effects on price efficiency. And in fact, that's sort of the second point here. The more flow and the more retail flow actually is basically redirected from the reference market. That will also have effects because it's not about losing market share or anything. It's about the fact that obviously the more flow moves to less transparent markets. I mentioned already the example in terms of you have only execution against one market maker, for example, or systematic internalizer, where there's generally less transparency. That will have obviously effects on also on the reference market, because there's less price formation, and hence that will also lead to basically higher implicit costs because spreads get higher and so on, and eventually also on the reference market. And that's then obviously bad for all investors in the end. in the long run. So price efficiency will deteriorate. And for me, it's important also to stress again the fact that what we see here is the competition obviously is an important factor. Also, obviously for the benefit of price formation and so on. But the fact is that the competition has really shifted towards payments, like who's paying the most, that those can participate, away from basically competition around price level. And that's obviously also the further point in this competition amongst different trading monies. Anyone who wants to join, if you're not paying, then what I mentioned is then obviously you are out of the game. Or if you want to pay, you have to even make higher payments to participate, because competition gets tougher around this. And I think the other point, the final point, is it may lead also to poorer prices for investors. If you mention again an example of where a market maker, I mentioned earlier on 100 million in total in Germany in 2020. Even if you say one market maker pays 10 million per year, I mean, he needs to earn this back somehow. And this is also displayed here a little bit on this illustration on the graph with payment for order flow. The only way you can earn it back is via the spread. If the spread widens, so that's obviously higher implicit cost than for the retail investor. That's not that's what he might not be aware of even, and that's obviously not good for the investor himself. Also, if you consider as well that retail investors also trade a lot outside of trading hours, where retail investor even can't compare to the main reference markets what is actually the current price. Such a market maker would have much more even possibilities to widen the spread and earn it. There's no such obviously thing as a free lunch. Hence, you will earn it only back via the spread. There have also been lately 2 studies that have been conducted by regulators, the Dutch AFM and also the Spanish CNLV. They have come up with some analysis and find out in terms of those venues that were making where execution venues were participating in payment for order flow, and what the transaction execution prices were, and the results actually confirm that the investor is basically worse off. In that sense, we have also here some examples from the Spanish and the Dutch market to actually show that there might be a problem. Now, how is payment for order flow actually currently being dealt with in the European Union? I mean, according to MiFID rules, which I mentioned earlier on already before, and the fact is obviously, yes, inducements are allowed if they enhance service quality of the service, and also if they act in the best interest of the client, and that's a question. ESMA actually is of the opinion and says, well, payment for order flow is not compliant with the rules of MiFID II. And now that we have the MiFID II review, the EU Commission came out with its proposal in December last year, and the Council and Parliament are looking at it. So the European Commission went for a clear ban of payment for order flow. Gave its explanation also. It's not, it's basically, the text basically also, when you look at the text specifics, it looks at the perspective of really an investment firm, acting as a broker, and that the ban extends to all parties addressed by the investment firm, and even sending their clients flow. So the debate has been going on for quite some time now, and it's been going to be interesting to see what the Council will finally come up with, and also the Parliament, before then the negotiation starts later this year, or maybe earlier next year. We'll have to see obviously how the process will follow, but we expect maybe something in the French presidency from the Council to also have a position here. So it will be very interesting to follow this, and that's basically in a nutshell. I hope I've brought over the topic a little bit, and I'm happy to have any questions, comments, remarks, any thoughts, anything that you would like to add to the discussion.
Thank you, Sandra. I see that there is a question on the chat for you. If you have any comment on the recent German non-paper on this topic.
So the question is, do you have any comment on the German non-paper on payment for order flow? So yes, we have seen the paper on payment for order flow from the Germans, and yes, Germany in that sense is not in favor of a ban. So I think they have a clear position on this. We, from a trading venue, we take a bit of a different perspective on this, as I just outlined. But yeah, we are aware of it, and we have to see of how the discussions go now in the council. I think member states are at the moment defining their positions. I know that some member states, for them, payment for order flow is not so much of a concern, or maybe they don't even have the issue of payment for order flow. Others, for example, the Netherlands, they actually banned payment for order flow a long time ago, even before MiFID II came in place. We know also others that, for example, UK, they kind of have a sort of a ban on it as well, but they're no longer part, obviously, of the European Union. I'm very curious as well to see this discussion going on and to see what the council will come up with.
Are there any other questions that the participants would like to ask either to Sandra or to the other presenters? Okay, I think the presentation was very comprehensive. We cover a lot of topics, so probably there is quite a lot to digest. So if there are no further questions at this stage, but you have any remarks afterwards, please feel free to contact the FESE Secretariat, and either we will respond to you or we will put you in contact with the presenters so to have a more comprehensive response. So I would like to thank you all of you for participating in this third FESE webinar, and to our presenter from the Deutsche Akte Institute, Deutsche Börse, and as well the Deutsche Börse Capital Markets Academy for joining us. So as mentioned at the beginning, the slides will be shared via email. So thank you very much and have a good evening. Goodbye.